The Ivy portfolio from Meb Faber is based on the endowment funds of Ivy League schools. Here we'll take a look at its components and the best ETFs to use in its construction. The Ivy portfolio is the product of the famous Meb Faber researching the highly successful endowment funds of Harvard and Yale. He presents a simple, equally weighted portfolio that any investor can use to replicate the same asset allocations with low-cost ETFs. Here's what the book looks like. I'd also highly recommend his book, Global Asset Allocation: A Survey of the World's Top Asset Allocation Strategies. The Ivy portfolio looks like this: 20% total US stock market, 20% international stock market, 20% intermediate bonds, 20% commodities, and 20% REITs. I'd be a bit hesitant with the high allocation to commodities and REITs, considering the idiosyncratic risk of the real estate market and commodities' very poor historical performance, but these pieces may help lower the portfolio's volatility and risk. Endowment funds are more concerned with that objective than with maximizing returns, as their time horizon is essentially perpetual. Going back to 2002, the Ivy portfolio's performance has been pretty dismal compared to the S&P 500. This shouldn't be very surprising though. I've explained elsewhere why we wouldn't expect commodities to deliver a positive real return, and this portfolio allocates a huge 20% to them. Unfortunately, the Ivy portfolio's volatility and max drawdown aren't terribly different from that of the S&P 500. This is because intermediate bonds at a 20% allocation don't have much protection to offer. This piece should almost certainly be long-term bonds, as more volatile assets make better diversifiers, especially when we've got 40% in stocks and 20% in REITs. As a result, for this time period, the Ivy portfolio still even had a lower risk-adjusted return, a measure of return per unit of risk, than the S&P 500. Investors interested in this type of well-diversified, risk-mitigating portfolio may be more interested in what I would consider our superior options, which would be things like the all-weather portfolio, the golden butterfly portfolio, and the permanent portfolio. You should be able to construct the Ivy portfolio at any major broker using popular ETFs that I'll go over here in a second. I think M1 Finance is a great choice for US investors to implement the Ivy portfolio because it makes regular rebalancing seamless and easy with one click, has zero transaction fees, and incorporates dynamic rebalancing for new deposits. We can utilize mostly low-cost Vanguard funds to construct the Ivy portfolio with the following ETFs: VTI at 20%, VXUS at 20%, VGIT at 20%, PDBC at 20%, and VNQ at 20%. I'll provide a link for this pie for M1 Finance users for the Ivy portfolio in the description. What do you think of the Ivy portfolio? Let me know in the comments. Thanks for watching. Some of the links below are referral links at no additional cost to you. If you choose to make a purchase or sign up for a service, after clicking through those links, I may receive a small commission. This allows me to continue producing high quality content on this channel and pays for the occasional cup of coffee. I have first-hand experience with every product or service I recommend, and I recommend them because I genuinely believe they are useful.